Yeah, hello. Now let's go on with the corporation tax system topic in our lecture Business Taxation. And this time I'm going to speak about the treatment of the expenses which are connected with the gains which you make if you are a parent company and sell shares in a subsidiary or in any other company. We have repeatedly already mentioned that there is usually in tax law, and especially therefore also in German tax law, a principle that a revenue and an expense combined with that economically should be treated alike. It makes usually no sense to say revenue is tax-free and expense then can lower the rest of the taxable income. If you tax income, you look to the net result, so you try to view revenue and expense together. So if revenue is tax-free, also expense will probably be treated as tax-free. So if a company sells shares free of tax in another company, shares in another company, that should imply that not only the price which you get for the shares is tax-free, but that also the book value and the costs of the transaction, so costs for a tax advisor preparing the deal, for a lawyer involved in the contract where you sell the shares and all that stuff, that the cost of the transaction too will be non-deductible, that they cannot lower the taxable profit. Indeed, when you look to the rule on the tax exemption in 8b2 German KStG, there it says, if a company sells shares in any other company, then the gain from the sale is tax-free. And then the rule is compute the gain as price minus book value minus all costs related to the sale. So only the net result is regarded as the gain and only the net result is tax-free. So by that formula, automatically it is ensured that the book value and the costs of the transaction lower the tax-free amount and not taxable other amounts. Okay, so here, by the way, how tax-free gain is defined automatically, the connection between the revenue and the corresponding expense is upheld or established. That fully complies with the principle. It's cleverly hidden. You don't see it at the first glance, but it is absolutely convincing. Now, there is another additional rule. You remember another problem or another idea which we had was that dividends and gains from shares should be treated alike. Now, when we have dividends which we collect, there was in that constellation which we have here a rule that 5% of the dividend coming in is to be treated as a non-deductible expense. Now we find such a rule also in 8b3 KStG for cases where you sell shares in another firm. 5% of the profit, the gain from the sale, shall be treated as non-deductible. That surprises a bit because we have just learned that the actual expense from the sale is already treated as non-deductible. So why a 5% lump sum on top? Well, so why? That's the question. And it takes a bit of a time to find that out. The explanation is not the actual transaction at the moment selling the shares. The explanation for the additional 5% lump sum can only be found if one takes a look back in time to the years and decades before you sold the shares. Because you remember that during the time where you hold shares in another company and you are a company yourself, the dividends coming in are tax-free. And so the expense correlated to these dividends should be banned from deduction, but one wants to make things simple. So one says, we estimate that expense with 5% of the dividends coming in. In the long run, this will lead in the average to an adequate amount of expense banned from deduction. And as a consequence of that, we allow you and even expect you to fully deduct all the actual expense. And now there was a very easy way to avoid getting hit by that 5% lump sum rule. You just never pay out a dividend. You keep all that money in the subsidiary. When you need some liquidity, you ask the subsidiary for a credit and pay interest to it. But you never pay it out as a dividend. So in that case, the parent company can always fully deduct all the costs and never gets hit by that 5% lump sum rule. And then some people found out, okay, and when the time then comes that the parent company needs money, they just sell the shares tax-free to somebody else and collect all the money, because when you never pay out dividends, then it's clear that the money piles up higher and higher in the subsidiary. And if at a certain given point you need money, then you don't ask for dividends, you just sell these shares. And so you would get along, or you would get around that 5% lump sum for eternity. You would never pay any non-deductible expense, or never have any non-deductible expense for the whole period of time during which you held that participation. And this is so easy for companies holding, let's say, more than 50% of the shares, that the legislator cannot tolerate this construction. So we need a kind of a countermeasure. They need to invent something which helps against this idea. Well, and now what they really did is that, well, let's have a look to the economic situation in such cases. Imagine that we here have two companies, the P GmbH and the S GmbH. Please ignore that 100,000, that's wrongly animated. It comes into play later. Now, P, for reasons of simplification, it just has 100% in S GmbH, but that doesn't really matter. Now, in the beginning, that P GmbH founded S with a contribution of 100,000. So we have P, we have S, and we have now paid in capital of 100,000. And that paid in capital, please ignore the other 100,000 here, you know, wrongly animated. That paid in capital is reflected in the balance sheet of P GmbH by shares with cost of acquisition of 100,000. Good. Now, after a year, S GmbH has made a profit of 100,000, and here they come in year one. Now you can have the first alternative. You just distribute that money to P GmbH. So you pay it out as a dividend, and in that case, 5,000 euro, 5% of the amount which you receive as tax-free dividend would be non-deductible expense in the profit or loss statement of P GmbH. Now you could say, well, there is another alternative. We just renounce on that dividend payment and we keep that money inside of or within S GmbH. So in that case, no dividend flows, no 5% lump sum hits P GmbH. The 100,000 become retained earnings, and well, an automatic consequence of that is the market value of the shares in S GmbH will now go up from 100,000 to at least 200,000, because now the property which these shares represent has increased to 200,000, and so the value of the shares must necessarily follow. Okay. Now, these are the two alternatives, and let's imagine PGmbH is rather a bit shy of paying 5% lump sums, so they decide for alternative number 2. The money is stored in form of returned earnings in SGmbH. Well, next year, this is the starting situation. Then next year, SGmbH surprises us by making a profit of 200,000. Again, we have the two alternatives that we could either pay that out in form of a dividend, 200,000. That would then entail a non-deductible amount of 10,000 in the profit of loss and loss statement of PGmbH. Maybe they do not want that, then they want to renounce on that dividend payment, forget it, and they place these 200,000 again in the retained earnings. Now it's clear SGmbH has now a property which has gone up to 400,000, so the value of the shares in SGmbH held by PGmbH has now at least a market value of 400,000. So if you sell these shares after the first year, you would have sold them for a market price of at least 200,000, so you would have made a gain of 100,000. Now, after year 2, if you sell these shares now, your minimum gain is 300,000. So all the money which you did not pay out in former years pushes up the gain from selling the shares. And that is the vital insight which we need to have, because every time when profits are not paid out as dividends, or as far as they are not paid out as dividends, you avoid the 5% lump sum for these amounts in that year. But on the other hand, you push up correspondingly any later gain of the shares in the future. So here we see in the first year that we didn't pay out the dividend amount, the profit as dividend pushed up the gain from 0 to 100,000. Later, we push up that by the additional 200,000. So the market value then goes up to 400,000, and our potential gain, the hidden reserves, go up to 300,000. So whenever you do this, you always increase the future gains. And now the legislator just came to a very, very simple idea. They said, well, now every time when somebody doesn't pay out dividends, the gain is increased. So we don't get our 5% lump sum now, but if we then demand a 5% lump sum on the gain, we get these missing 5% for the current expense later at the moment when the gain is realized by a sale. And that is the reason for that 5% lump sum on the gain, which you make from the shares, that this is to be treated as non-deductible expense. So that doesn't compensate the expense correlating to the actual selling transaction. This is a delayed compensation for the current expense of former years. So it compensates all these 5% lump sums which have not become relevant during the time when you held the participation. And now, okay, it might be that the gain is even higher than the 100,000 or 300,000 retained earnings which you piled up in the time between when you founded the company or bought the shares and later sold it. But well, from the perspective of the legislator, that's nothing to complain. Okay, if my 5% is then too high, well, why not? So this is rather a way just to make sure that the 5% lump sum cannot be avoided. And that needs to be done, because otherwise that 5% lump sum would be, especially in groups where somebody has a majority, completely easily avoidable, and nobody can ever tolerate such a thing. By the way, that 5% rule here in 8b3 was, as far as I try to remember, not present in the first draft of the law. So that was a kind of an afterthought later when people found out, oh, these people in the industry are all complaining about the 5% lump sum expense, and they try to convince us that 5% is too high and 3% would be better, or 2%. But in reality, we now find out no important firm ever pays this 5% rule. So in such a case, just to avoid that, or to close the gap, that additional rule was necessary, evidently. Yeah, good. Furthermore, which other things do you need to know? If selling a share with a gain is tax-free, then naturally, if the gain is a loss, it's also tax-free, so not deductible. That is clear. Now, technically, you can avoid a loss, selling something by a loss, always if you are good in bookkeeping. You first just make an impairment, so you write down the book value to the present market value. Then you have impairment expense, and then you sell at a gain of plus minus 0. Naturally, if a loss is tax-free, so not deductible, then a logical consequence is that you also have to declare an impairment expense as not deductible. If not, the whole thing would create fits of laughter for everybody who knows about bookkeeping rules. And so it's clear that we have also in 8b3 a rule that amounts which lower the profit and which are connected with those shares which are covered by 8b2 are not deductible. This aims mainly at the exclusion of impairment expense, but officially also covers any other expense which lowers the profit and is related to the shares which could be sold tax-free and can only bring tax-free dividends. Well, now there were some people who then reacted to that non-deductibility of a loss when you sell shares or when a company goes bankrupt. And they just said, okay, as we are clever, we try to combine the best of two worlds. We want to have profits which are tax-free, and we want to have losses which are, if they occur, deductible. So what we do is, first, we found an SGmbH with a minimum amount of capital, let's say 25,000. Then afterwards, all the rest of the capital is given by PGmbH in form of a credit to SGmbH, because now we have a claim from a credit against S, and S has liabilities of 9.975 thousand or so. Now you have, as always in life, two possibilities. First, SGmbH could flourish so that the value of the firm explodes. You have an enormous goodwill after a while, so you have, let's say, 500 million after a while. Which of the two items which you hold as PGmbH will then increase in value? Well, the credit claim is fixed. You have a claim to 9,975 thousand. You have them paid back. There will be no effect if the situation of S gets better. The only thing which constantly will increase in the market value is the shares. So in that case, if you really have 500 million value of the firm, nearly all the 500 million will be combined with the shares. You sell the shares, you make a profit of 500 million, it's tax-free. That's at least the simplified version. Now, on the other hand, it's always a possibility that SGmbH goes to the wall, gets bankrupt, insolvent, and that you lose all your money. In that case, the shares become worthless, so you book out 25,000 and have a loss from the shares. And you book out the claim, and now that's a loss of a claim. And there is, up to now, or there was at that moment, no special rule for that. So you would then have a loss from a credit claim, and usually that is deductible expense. So here you would have the best of all worlds if the chance realizes itself. If you have success, then it's a tax-free success. If the project fails, then it's a deductible loss from credit claims. Now, naturally, that was an approach which did not really meet the humor of the people who wrote the law, because you would have had all the risks deductible and all the chances tax-free. As a consequence of this, 8b3 was then also extended by a clause which says, okay, if you are a parent company, so if you are somebody who holds 25% or more, so that you really can influence the behavior of the subsidiary company, so that you can bring them not to ask for equity but for credits instead. In such a case, losing a claim against such a company leads to non-deductible expense, apart from cases when you can talk yourself out of all suspicion that the credit was serving such a tax-saving model as here. So usually the rule is, if a parent company loses a financial claim against a subsidiary company, this is not deductible. That follows from that tax trick which I described to you just now. So to sum it all up, what we find in relation to expense connected with shares held by a company is that first, the gain is tax-free, and how the gain has to be computed: price minus book value, which is, by the way, very often forgotten by people to deduct the book value, and the cost of the transaction: notary costs, lawyer costs, tax advising costs, and so on. This is then done. From the remaining gain, an additional amount of 5% is declared as non-deductible expense. You remember that is not for the tax-free sale. That is a compensation for all the 5% lump sum for current expense which did not take place in the former years. And furthermore, expense from impairments is not deductible. And last but not least, strangest of all, if you lose a claim from a credit, a financial claim against your own subsidiary company, then that can be non-deductible expense under 8b3. So now we know a bit about the treatment of expenses combined with shares held by one company in another company, and that should be enough and motivate us to make a small break and to continue with yet another chapter in the next video. That will then be special problems in cross-border situations for the corporate tax system. Thanks for watching. Till later.